Well, it's a lot better than yesterday. I mean, it's not runaway, but it's a better day than yesterday. Stocks are bouncing back for the most part. A lot of moving in and out the positive territory for the Dow, but the S&P and NASDAQ holding pretty well. This is President Trump holding a trade meeting with senior advisors today. And Larry Kudlow says Trump and President Xi of China, will talk trade at the G20, while Treasury Secretary Steven Mnuchin and the Chinese Vice Premier have reportedly already resumed discussions about a possible trade deal. That would obviously ease all of the trade tensions. Here now to help break it all down, Money Map Press Chief Technical Strategist Dr. Barton, CFRA Research Investment Strategist Lindsey, Janney Montgomery Scott, Chief Investment Strategist Mark Luschini. Mark, let me start with you. What I find interesting is a week ago when Larry Kudlow sort of talked about there was no talks, the Chinese have been unresponsive. The market was down a lot more than it's up today. Is there just more skepticism setting in, or what's going on?
Charles, I think it is. I mean, in fact, it wasn't all but less than a week ago in which you had both Larry Kudlow and President Trump saying diametrically opposed statements relative to whether trade talks were even occurring or not. And so I think there is a fair amount of skepticism. It's become very much a show-me situation with regard to trade, because we've been teased before by these so-called meetings and discussions that ultimately lead to nothing. Now, I think if we do get some resolution around trade subsequent to either these discussions or President Trump meeting with President Xi in Buenos Aires, then I could see 100, 150 points being put on the S&P 500. I think that's how much concern is baked into equity prices at this juncture. But at this point, it's show me.
Lindsey, although, a lot has occurred, right? A lot of economic data has come in. We know China is having a tough time of it. October, auto sales were down. This could be the first year ever for the Chinese economy as a major car importer to see year-over-year declines and a lot of other things. Meanwhile, their banks are the government forcing banks to buy corporate debt. So there's some cracks in their the veneer of economic invincibility that have been, some people thought. And by the same token, in America, we've heard Trump now say he wants to make a deal. We hadn't really heard that, but he's been more optimistic with respect to saying, hey, I'd like to get something done. What do you think?
Yeah, I mean, in China, they're certainly feeling the pain over there. They're definitely taking steps to try to stimulate the economy. They're sort of manipulating the currency to an extent to offset some of the tariffs that have already been put into place. Look, this meeting at the end of the month is huge. To us, this is the biggest risk facing the market near term, because this has huge implications for the global equity market as we get into 2019. If those 10% tariffs turn to 25%, or tariffs are put on the remaining portion of $267 billion in goods that come into our country from China, the equity markets are going to have a real problem with that. And everybody better start batting down the hatchets and really sort of, get more defensive in nature with their respect to their investments.
DR?
Yeah, Lindsey is on the same page with me in terms of the biggest risk factor. If we come out of this G20 meeting with some head knocking instead of some agreement, I think we could derail what is traditionally one of the strongest periods in the market. And we've talked about the tailwinds that we have from the presidential cycle right now, which I'm a big believer of. And the next 9 months are the strongest part of that 4-year cycle. I think we put that together with the earnings we're seeing, with the end of the year Santa Claus effect. We should have a really strong run-up. This could derail it.
Do you think Wall Street and the Wall Street talking heads are more concerned than corporate America? And the reason I bring that up, third quarter earnings are out, and right now 33% of companies mentioned tariffs. In the second quarter, it was 38%. Right. In fact, more companies have mentioned currency, more companies have mentioned raw material costs, and more companies have mentioned wage increases than they have tariffs. So are the Wall Street experts making more of this than the companies that are on the ground who actually have to make a living in the global economy?
I believe that where we're making more of it is that the release of this, the resolution of this, we're thinking that the administration's got the long game in view, that they're negotiating, not planning on having onerous tariffs blast us through 2019. I think that we're saying if the things get resolved to the upside, the market has not taken a big drop down in any of these tariff things, percents, not tens of percents, because we think they're going to get resolved. If they don't get resolved, I think then everybody gets worried.
You know, Mark, other issues, for instance, I'm more concerned, to be quite frank, I think the biggest headwind happens to be the strong dollar, and for me, the biggest risk to the economy and the market, in my perspective, is the Federal Reserve. What do you make of those two things?
Well, I think those are realistic concerns, Charles. I mean, if you think about it, the U.S. dollar, having strengthened the way it has so far this year, is obviously moving from being a tailwind in 2017 to a pretty severe headwind, and is likely, I think, to continue to strengthen. And therefore, since S&P 500 companies derive about 44% of their profits from overseas markets, that's going to obviously influence the glide path towards earnings that I still think will be good on a year-over-year basis, but are clearly decelerating, and the unanswerable at the moment is decelerating to what? And of course, the Federal Reserve is the other boogeyman out there relative to the level of interest rates and where the so-called neutral rate is. And are we still accommodative, or in fact, has the Fed already raised rates to the point where it may not be tight for the U.S., it's just tight for the world?
Lindsey, how do you see the year playing out just from what we know already?
Well, I think when you look towards 2019, look, growth is going to decelerate across the board. We're looking for 8.2% earnings growth in 2019 off of over 22% in 2018. And I think that really became reality for a lot of investors as third quarter earnings kind of made its way through. The third quarter was a blockbuster, over 28% earnings growth. But as we look out to 2019, you've mentioned some of the issues that the market is going, that these companies and the market is going to face. And it sort of became reality. And every time that 10-year yield reaches close to 3.25%, the market becomes skittish, because it's going to have real implications on the discount rate at which you have to value these companies at. So while we're going to see a deceleration, 8% on the bottom line is still very solid growth. I
guess the operative word or thing is that at least we still have growth, right? It won't be the kind we've enjoyed this year, which has been magnificent, but maybe growth in of itself could be the saving grace. Hey, wish we had more time. You guys are fantastic. DR, Lindsey, and Mark, thank you all very much.